Okay, great. Good morning, everyone. Welcome and thank you for taking the time to join us for today's presentation. My name is Barbara Da Fonseca. I'm the principal of the company, and Paul McVean here is joining me today. The both of us are chartered professional accountants who have prepared, analyzed, reviewed, e-filed, I suspect, over thousands of tax returns in over 25 plus years. And we're here today to bring a value add to you, our clients and friends, to help maximize your wealth, to help reduce your personal tax liabilities, to help increase refunds, and to help educate you and to help you ensure that you submit the information to us so we can help get you those tax credits and deductions that you qualify for. We're very happy to be with you here today. Just a few housekeeping matters before we get started going through the slides. Today's webinar is being recorded. It will be available on our website, hopefully by the end of next week, together with the slides. If you do want a copy of the slides before then, you could always email one of us, one of the BDCA team members, of which most of us are on here now with, you can see us with our BDCA backgrounds. And one of us can send it to you, or else you can just email info@bdca.ca. We have muted everyone's microphones just to prevent any unexpected interruptions. And as well as if you have some questions, please use the chat function, which is located on your Zoom menu bar. Please post it so that everyone can see. And at the end of the presentation, we will go through the questions. We hope to be able to address all of them. We hope to have all the answers, but if we run out of time or we might have to get back to after the presentation. So without further ado, I'd say that we should get started. Okay, so thank you very much. Agenda. We actually have a two-page agenda. There is so much information that we want to share with you. Home office expenses is going to be one of those topics, but there's 9 slides and there's so much to go through. So, some of them we might have to flip through a little quickly, but again, you will have the slides to take away. You can always check in with us afterwards. So here we are. Who has to file a return and why file a return? Some information about CRA updates for you, COVID repayments that have been going on, the multi-generation home reno tax credit that exists now, some valuable information for seniors in general, the flipped property rules. We've all heard about those. Maybe we've even experienced them. Rental properties, property sales in general, medical expense refresher, as well as we'll be discussing a little bit about investments in cryptocurrencies, as mentioned, the home office expense, retention of books and records, installments, RSPs and the FHSA, that new first home savings account, the UHT, underused housing tax return, and then of course, what is a trust? There's going to be a fair bit of discussion that Paul will be leading about the new trust filing rules, and then we'll just go through a few other administrative items. Okay, so this is just a recap as to where we were with tax rates for 2023, which is essentially the same for 2024. As you can see, Ontario there, 53.53% is quite high. This is the top tax bracket at 220,000 or up, or more than that. Taxpayers were paying 53.53% on ordinary income, which is like employment income. Of course, we know capital gains are half of that, so that's a 26.7. But as you can see, this is just a nice chart to just kind of look at. I've heard some people say they're going to move to Alberta because they don't have the HST and they have a lower, the PST there. But I reminded them a few weeks back it was minus 50 degrees in Alberta, so they might want to think twice about that. But anyways, there's the rates do fluctuate across the country, and we're definitely in one of the highest. There we are. And this is just the individual bracket. So, if marginal tax rate. So you can see how here in Canada and specifically in Ontario, these are the rates that continue to increase. Other income, essentially employment income, grows and grows and grows. The more you make, the more taxes you're going to pay. And of course, here, 53.53% is that top rate we're paying. So it's very, very high. Okay, so who has to file a tax return? Well, if you owe taxes to the government, you have to file a tax return. If you want to receive certain benefits and credits like the Canada Child Benefit or your old age security, your Canada Workers Benefit, then you also have to file. If you want to report some earned income that maybe you don't owe any taxes on, you would likely want to increase your RSP contribution room, but you've got to file a tax return so that CRA can know that you had that earned income, as well as if you cease being a Canadian resident. If the CRA sent you a letter, a demand to file, you have to. If you want to split pension income with your spouse, you have to report this. So quite a few reasons why you'd want to file even if you don't owe any money. If you've overpaid taxes, if you don't file, you're not going to get them back. As mentioned, you want to generate some RSP room and receive certain government benefits. Also, a lot of people don't realize that, they figure on their investments, they might have lost some money, incurred, some capital losses during the year. So they figure, well, then I don't have to report it. But certain losses can be carried back 3 years and forward for a certain number of years. So you need to report them to the government in order to benefit from those loss carrybacks or loss carry forwards. In particular, for example, a capital loss, you can carry it back 3 years to recover taxes that you paid on capital gains 3 years ago, or 2 or even 1 year ago, or you can carry them forward indefinitely. The same thing with donations. If you can't deduct them this year, you can carry them forward to future years, and unused RSP contributions as well that you've made. Okay. So just a little update here on CRA and their service standards. They pretty much have remained the same. So if you e-file your tax return, you should get a response within 2 weeks, the notice of assessment. But notice how if you send it in by paper, well, first you have to say a prayer that it'll actually make it there. But if it actually does make it there safely, you have to wait about 8 weeks. It's possible it'll take. So if you're in a hurry to get your notice of assessment, you need some financing for refinancing the current mortgage or anything like that, could take up to 8 weeks by paper filing. So you really want to make sure you can e-file. There are certain instances where you're not allowed to e-file. So keep that in mind. But if you can, e-filing definitely is the way to go. Telephone wait times, well, Anthony checked this morning and it's 9 minutes as of this morning. So that's actually quite good for the CRA. I don't know if anyone recalls during COVID times, it's sometimes up to 2 hours waiting on the phone. Even if you're retired, that's not enjoyable and you have nothing to do and you're at home, or you're taking the day off work, 2 hours to wait for the CRA and potentially have the line go, get cut off is not fun. So we're very happy to see this improvement. They still have the automatic callback service, and there's just the phone numbers there for you. We still do encourage, though, everyone, and most of the clients and our friends have registered for CRA My Account online. It's a little frustrating at first to get set up. It takes a little bit of time and a little bit of back and forth, but once you do get set up, it's very, very efficient, and you can dial in and find a lot of information, including all your tax slips there and important letters. Okay, some audit and review campaigns that are going on with the CRA. They love foreign tax credits and auditing them. Perhaps a lot of taxpayers are making a mistake in claiming them when they can't. There are certain dollar limits. Sometimes amounts are listed as foreign tax credits, but the tax in the foreign tax paid on a tax slip, but they're not always fully deductible. If there's a tax treaty between, let's say, the Canada and the US that says only 15% is deductible, but that box includes other taxes paid to the US as well that makes it greater than 15, you can't just put that dollar amount in the box. You're then overclaiming. So in either case, there's a lot of foreign tax credit reviews going on still. Donations, they love to audit donations and medical expenses. Even if you've been approved for the disability tax credit, even if you proved to them that you paid $60,000 to live in a nursing home because you required it again, and you qualified for the disability tax credit, and you're 85 years old, it's still very possible they'll ask to see those receipts. So it's very important to keep them. Vehicle expenses, including detailed mileage log with dates that you met clients, the addresses, Yes, they're getting more particular with the mileage log. We found this past year. Support payments, um, marital support, child support, they continuously review those, and employment expenses. Okay. COVID repayments. So for your tax return this year, some of you may have had to repay some COVID benefits that you applied for because you thought you qualified, but you didn't. Those repayments are deductible on your 2023 return, okay? So even if they pertained to a benefit you received in 20 or 21 or even 22, they are deductible on this year's return. So please make sure to submit that information to us. The multi-generation home rental tax credit. This is a great one, and I think it could qualify for many, many people. It is refundable. Okay, so refundable. If you spend $50,000 in your home, and let's say your disabled brother is moving in or your elderly parent is moving in, and you spend $50,000 to build a secondary unit, then you will get $7,500 cash back when you file your personal return. So again, another reason why you want to file that return. So it has to be an eligible dwelling, it has to be a qualifying individual and a qualifying relation. Like the perfect example is my brother and my mother moving into his house, right? She's over 65 and he has built a little unit for her. You know, it might have a separate driveway, maybe not, but a separate entrance. And so it's a great, great credit. Now, here's the interesting, if you see on screen, it's an eligible dwelling owned by either party where both intend to reside 12 months after the renovation period. That's interesting wording, right? Intend. So there might be instances where you find you qualify even if you didn't end up, let's say mom didn't end up moving in or your disabled brother. So this is a really, really good one, $7,500 cash refund. Note that this qualifies only once per life, okay? So you can't do $50,000 every single year, just once in your lifetime. There's some information on the qualifying rentals, kitchen, bathrooms. You have to claim it in the year it's complete. So if construction takes 2 years for whatever reason, you have to claim it in year number 2 when the construction is complete. You also cannot claim the same expenses if they qualify for the home accessibility tax credit or the medical expense tax credit. Okay, so you can't double dip with this one. Some information for seniors. As we age and we get more wise, we also get a little bit more tax credits. And here are some that we've listed for you. And this is another reason why it's very important that you hire a qualified individual to prepare your tax returns so we don't miss out on any of these things. There's more, but we just highlighted some of the more common ones. So split pension amount, income splitting. This is a great one where we love to be able to transfer some pension from a higher earning spouse to a lower earning spouse. It varies with the type of pensions, not all qualify, and with age, but this is a great one that we're able to do for many of our clients. There's also many federal tax credits, which in general, 15% of these amounts will reduce the taxes payable. There's age amount, born in 1957 or earlier, home accessibility expenses, so up to 20,000, but again, no double dipping with the multi-renovation tax credit. Canada caregiver amount for infirm dependents. If you receive eligible pension income, then you get a credit of 15% of the 2,000. Seniors and not seniors will receive donation tax credits, but all donations in general cannot be greater than 75% of an individual's net income, and you can carry forward unused donations for up to 5 years. Okay. And provincial tax credits, there's the Ontario Seniors Care at Home credit. Maximum 1,500. That's for lower income earners of a family combined income of 65,000 or less. We don't see that one too often. The benefits aren't that much, but again, you can get some, so why not? It is refundable, so it's another one we like. We always like it when tax credits are refundable. And there's finally the seniors public transit tax credit, refundable at 15% of 3,000. So many seniors are using the York Region Transit that they pay for. I think it's $4.75 per way. So if someone comes to your house to pick you up and take you somewhere, it's almost $10, and do that twice per day. That's $20. It does add up. So you can easily reach the max of 3,000 and get a refundable credit, which always helps. The good old flip property rules that have come into play. Okay, so a lot of people, a lot of Canadians have more than one property. A lot of individuals, some have rental properties, and of course, cottages, especially in Ontario. We're quite famous to also have cottages. But these flipped property rules are focusing on properties that are held less than 365 days. So you have to hold it less than 365 consecutive days in order to fall into these rules. If that is the case, there is no principal residence deduction that's allowed, even if you lived in the house and used it as your principal residence. It's deemed to be business income unless the disposition occurred due to certain life events. And we'll show you some examples on the next slide. And also the period waiting for registration of a property, such as a condominium, for example, does not qualify as your owned period. So let's say you had a right to purchase a condominium, and you know how you start renting it at a certain point, you're forced to rent and pay the interest to the builders at a certain point, and you do physically start living, but only once title transfers and that condominium is registered is when the 365 days starts. So it's a little bit even more punitive to those that are living in condominiums for more than 365 days technically, but the date of purchase only started perhaps 8 months in, so the clock starts ticking again. Here are those life events. So this is not an exhaustive list of every event, and these rules are new. So I'm certain there will be many tax court cases that will involve these rules. And so we will find out how the Tax Court of Canada or the ministry rules on them as we go. For now, this is, we're all really learning with these new rules. They're not extremely black and white, but in terms of life events, so if your spouse moves and you're living in a large home, it makes no sense. You're going to move out. So that's a life event. Or, you become disabled. And now the home doesn't make sense, or you have to move out. Let's say threat to personal safety, domestic violence. You now have a child is born. So the current home is not appropriate for a child, or there's no child care in the area, so you have to move. Taking care of an elderly parent, or separation, divorce, etc. These are all valid reasons. Involuntary termination of employment. Perhaps now you're unemployed, you can't afford the mortgage, so you have to sell. Destruction, expropriation of the property, or even an insolvency. So there's quite a few reasons there. I mean, it's not an exhaustive list, but there are ways to not be penalized for when these kind of circumstances that are out of your control happen. So okay, rental properties. As mentioned before, a lot of us have rental properties. A lot of our clients, we see them, our friends, some family members. And this is just a recap as to the deductible expenses that can be claimed to reduce rent. Realtors will often charge the first month rent as a fee. We find clients might forget to include that as an expense for when they have new tenants that move into their properties. Insurance on the property, accounting fees, the mortgage interest, repairs. If you had a property manager, if you're fortunate enough to have many properties and have a property manager, then that can be deducted also. Travel expenses and motor vehicle expenses, you have to be very careful with these. Because many times the rental properties do not require you to visit them on a regular basis. So uh, you have to be there has to be a valid reason for those motor vehicle expenses to be deductible. They will be challenged if they are in excess, but in general, there normally isn't too many motor vehicle expenses that are incurred to generate the rental income. And home office expenses, generally not applicable unless you have multiple properties and um, and that's almost your full-time job having to manage them. So um, and of course, capital costs versus repairs and maintenance. Sometimes people will renovate and put on an extension and think that they can expense it and will reduce the rental income, but that is not the case. That is a capital cost. It will increase the cost of that property. So when you sell it, you'll have less of a capital gain. Um, and rental losses. CCA, or that's a tax depreciation on your rental property, can be taken, but it cannot create a loss from it. If you have multiple properties and one has a loss from CCA and the other has profit, you can use this excess to reduce the other property's profit. But if it creates an overall loss, you cannot create that, you cannot claim that excess. The other thing, you want to be extremely careful with rental properties. If you own a home that you live in and you're renting out your basement, and you plan on taking the principal residence exemption on that home when you sell it one day, you cannot claim depreciation on that home for tax purposes. If you do, you will not be allowed to claim the principal residence exemption, and the full gain on disposition will be taxable to you of your home, of your primary residence. So it's very, very important to not claim depreciation if you choose to file your own return. We won't do it, believe me, if you're renting out your basement and that's your principal residence. But if you do file your own, please do not claim depreciation on your principal residence. Property sales in general, whether it's your principal residence, rental property, or not, the capital gain is taken by deducting from the sales price your selling costs, which would include legal fees and realtor fees, as well as the overall cost of the property. That cost is going to be, yes, the original cost you paid for it a few years ago or maybe 50 years ago, plus the realtor fees at the time to buy it, plus the legal fees at the time of purchase, plus that land transfer tax that you had to pay, plus renovations that, and extensions that you incurred over the years. So these are all costs that will, we try to help our clients to gather them all up so that we can reduce capital gains if capital gains are applicable. For principal residence, they won't be, but if it's not a principal residence, these are costs that it's important to keep track of. Okay. A few credits and deductions that are unfortunately no longer available: the Ontario Seniors Home Safety Tax Credit, the Ontario Jobs Training Tax Credit, that Ontario Staycation Tax Credit that existed for a few years during COVID, and the Home Office $2 a day temporary flat rate method. Okay, those are no longer available. A quick refresher on medical expenses. A reminder that they must be paid. They must be paid, and in any 12-month period that ends in 2023. So for example, you could include unclaimed medical expenses that you incurred and paid for between July 1st, 2022 and June 30th, 2023 on your 2023 tax return. So that's why it's important to keep your receipts. And when you submit your medical receipts to BDCA, if we are unable to use them because they do not benefit them from you, we take note of that in our tax return files, and we also carry forward your receipts to your 2023, your future year tax year, so we can try to use them in the next year. But that's a very important rule that not everyone knows about. A lot of people also don't realize that travel insurance, especially the snowbirds or just travel insurance for outside of Canada, the premiums and expenses can be deducted also for Canadian residents. The total of your medical expenses must be greater than 3% of your net income, or approximately $2,600 there. There's a significant amount of attendant care and disability tax credit rules that are applied and that are on the CRA website. This is the link here that is available here and will be available on our website, or you can find it on the CRA website. But there's a detailed list, so it's a great idea when you're going through your receipts and getting ready for your tax preparation for 2023 to sift through those expenses. There's so many of them that I'm certain you've forgotten about some of them or just simply weren't aware. So it's really important to go through that list. And of course, you can claim them for your dependents also, your children or any family members that are dependent on you. This is a wonderful refundable tax credit here that is provided by Ontario. It's called the Ontario Care Tax Credit, Child Care Access and Relief from Expenses. Families with combined income up to 150,000 can receive this, and it's $6,000 per child. You can see the different dollar amounts for the different ages and situations for your children. It's similar to the federal child care expense deduction in terms of the lower income spouse must claim it. It's completed on a separate Ontario form, and it's calculated as a percent of your federal child care expense deduction. So if you can claim, for example, $5,000 as a federal deduction, then 75% of that would qualify for the Ontario refund. The thing is, as your family income approaches 150,000, that 75% starts to reduce to zero. Okay, so it is a great one though that's refundable. Okay, investments in cryptocurrency. I think we all probably agree that the world of investments and cryptocurrencies, especially, which are quite volatile and that fluctuate in price, and they're very complicated. There's been a lot of wins and losses with investments over the years and cryptocurrency these days. The prime thing that we wanted to express today is to remind everyone that when we're trading and like purchasing investments in foreign currencies, that we have to obtain from you the Canadian equivalent cost of the investment when you purchased it, and then the Canadian equivalent sales price at the time of sale to then determine what your Canadian gain or loss is. So that's very, very important that we have that information. So if we are given an investment summary statement that's all in US dollars, we always will come back to you and ask for the Canadian equivalent report from your financial institution. So it's very important to get that so we reflect the correct gain and loss on your return. We can't just use the December 31st, 2023 exchange rate. That would be absolutely wrong. So it's very important to have that. And as well, in general, whether we're dealing with investments and cryptocurrencies or stock of Facebook / Meta or Amazon, and what is it, Nvidia is really popular these days, and Bitcoin and Ethereum, whatever it is, the investment, if you are buying and selling daily, even though you have a full-time job or elsewhere, that is highly likely going to be considered business income in the eyes of CRA. So very frequent purchasing and selling of the same stocks, same investments, will lead CRA to believe it's business income, and the onus is on you to prove that it's not. So you have to be very careful in terms of the frequency of this. And sometimes it's not so bad to have it classified as business income, because if you're losing, then it's 100% deductible, right? The business income against all other income on your personal return, whereas a capital loss you cannot claim. So there's pros and cons, of course, of this, but whether it's investments in cryptocurrency or you're buying and selling houses frequently, flipping them, it could be viewed to be a business and not a capital sale. So just to keep that in mind. The CRA does have a guide specific for cryptocurrencies on its website. So which is quite useful. It's very detailed, but if you're interested in it, they do have it. And I know some of our clients are. We have a range of clients that are trading cryptos over various different industries and personalities. Many, many people have started trading. Okay, so home office expenses, there are 9 slides on here as a refresher as to what is considered a home office expense. As mentioned in a previous slide, the $2 a rule, $2 a day flat rate method no longer exists in 2023. And here are the rules for employees specifically. You have to have worked from home 50% of the time for at least 4 consecutive weeks. Your employer has to give you a T2200, okay, that form. So those rules, have been the same for quite some time. And in terms of calculating your home workspace, in general, you take the square footage of the area that you're using for work. And then you can use that to claim the proportionate expenses. So if your home office is 20% of your home, then you can claim the 20% of your utilities and different expenses that qualify. If it's rent that you're paying because you don't own, then it'll be 20% of your rent. But if that home office is not a separately designated area and it's a kitchen table that you use for many hours in the week, to have dinner or breakfast or on the weekends to share with friends and family, you then have to calculate how many hours you actually work at that table versus the total available hours, which is 24 hours a day times 7 days a week, to further reduce that 20%. So ideally, you have a separate space to maximize your home office expense that are claimable. Okay, so I think I've done a pretty good job of summarizing that. There is a chart here to help you calculate if you need an example to look at by going through the slides a little bit, after the presentation. Again, this is just chatting about that designated room. It's better to have a designated room so you don't have to further reduce your potential claim. And here's where we're discussing when you work at the dining room table. And here's a great chart to show you certain expenses that are eligible and certain conditions. You will see that commissioned employees can also claim these items on the right-hand side of the slide: home insurance, property taxes, lease of a cell phone, etc., whereas salaried employees that are not commissioned cannot. Okay, certain expense limitations for telephone and cell phone. You have to be careful to only include the employment use. You do have to support that with minutes. You should have a report from Bell or Bell Mobility, TELUS, whoever, that lists the minutes there, as well as for your internet. You cannot claim the portion of the fees that relates to leasing a modem or router. You cannot claim the initial connection fees when it's set up, but you can claim the home internet access fees. And condominium fees. This is one that I think many forget about or maybe are not aware. You can only claim the portion that relates to utilities. So if you pay a monthly management fee to your condominium corp that includes utilities that are paid for, then you can only claim the portion of that that relates to the utilities. If you are paying your monthly condo fees as well as you have a metered hydro that you also have to pay, then you cannot claim it from the monthly condominium fee. So this is one that I think Canadian taxpayers are not aware of fully. And here's just a nice summary chart, because sometimes it is confusing, these rules, and there's so many conditions and variables. If you're self-employed, you can see here that you can actually claim depreciation, mortgage interest, etc. If you're commissioned, you can't claim the mortgage interest or the other, but you can claim insurance and property taxes for that home office. Whereas if you're an employee, you can only claim the rent, utilities, and maintenance. Okay, so this is a great chart. And again, at the bottom there, it just summarizes when you can or can't claim it. Okay, with a little bit of information for self-employed individuals. And finally, with these home offices, you cannot create a loss from that employment. So you carry forward the excess. Again, the commissioned employees can claim more than the salaried employees, but they can't claim the home insurance, property taxes, or lease costs of capital equipment. And you can only deduct it against employment income that you incurred for the expenses. So if you are, if you have 3 jobs, but but only one is working from home, and you're claiming the home office for that one job, you can't use those home offices to reduce the employment income of the other 2. So we've been chatting a lot here about all of these deductions and credits, and we're getting to home offices and receipts and the home renovation tax credit, and the medical expenses, the donations. There's so many receipts that we have to keep and organize, and we regularly are asked, how long do we have to keep these receipts and this documentation? So this is just a quick little slide to remind you as to what the rules are. So we have to keep them 6 years from the end of the last tax year that they relate to. In Canada, they are supposed to be kept in Canada. You're not supposed to take them out of Canada, believe it or not, and you must obtain written permission otherwise if you want to destroy them sooner or take them out of Canada. So you literally can write a letter to your tax services office and ask them today if you can destroy the last 5 years of your documents, but you have to have a valid reason. So I haven't seen that one used too much, but I just want you to be aware that you can do this. Do remember though, if you bought your house 5 years ago, or no, say 10 years ago, so it's greater than 6 years ago, you do need that documentation to support your principal residence deduction and other in the future. So certain items you don't want to destroy, so be careful. And yeah, if you do want to request that early destruction of records, there's a form T1137 that you can complete and submit to the government. Installments, and I'm going to have to go a little bit quicker. Installments, if you owe taxes more than $3,000, your net tax payable, then you have to start paying them. They're due quarterly on March 15th, June, September, and December 15th. You can estimate your own taxes and pay what you'd like, but if they're less than the actual tax liability that's estimated by the CRA, which is based on last year's return, then you'll have to pay installment interest. So if you want to be safe, just pay what the installment reminder says that CRA sent you, or else you might have to pay some installment interest. And if it's greater than $1,000, then there's a penalty that's also charged for under remittance. And I think what I will do at this time, I'm going to switch it over to Paul McLean.
Hello, everybody. Thanks for being with us today. I'm going to carry on and talk about a few more topics before we finish up this afternoon. First, our RSPs. There is a limit for 2024 of $31,560 plus any unused limit from prior years. And to the extent that you make the contribution, you have the option to claim a deduction on your personal tax return. What people may not be aware of is that if you make the contribution, you do not have to claim the entire deduction right away. And you can carry it forward and claim it, and perhaps in a year where you have more income, where the deduction might save you more tax. So it's optional to claim the full deduction on what you contribute. Do not over contribute. There is a 1% per month penalty, and every year we end up dealing with a few clients who have put more into their RSP than their limit allows. And we have to file a T1 OVP form to claim the overcontribution and report the penalty to CRA. It's a self-reporting process, but we need to look after that should you fall into that position. And it is costly. So be mindful of what your RSP limits are and stay within them. New in 2023, we have a first home savings account, which is along the lines of an RSP, but specifically designed to allow you to save funds to purchase your first home. You can claim up to $8,000 per year in contributions to a lifetime maximum of $40,000. And you are able to use the funds, as I mentioned, to purchase a first-time home. Next slide. If you don't use the funds in your FHSA, they can be transferred to your RSP or RIF on a tax-free basis. And you can use both the first home savings account and the home buyer's plan to purchase the same first home. If you pledge this account as a collateral for a loan, then the full value of the account is included in your income. And unlike RSPs, these funds are not protected under the Bankruptcy and Insolvency Act. So bear that in mind should you run into issues. Next, I want to talk about the underused housing tax, which was something new this past year that caused many people to have to file a return. This past year, corporations, partners of partnerships, and trustees of trusts all had to file an underused housing tax return, even though tax wasn't necessarily owed. But going forward, the rules have now changed, and if there is a Canadian corporation, Canadian beneficiaries of a trust, or Canadian partners of a partnership, we are no longer required to have to file an underused housing tax return, which is good news. So this past year, this affected a lot of people. Going forward, it will essentially affect non-resident owners of properties. It's a 1% tax calculated on the market value or assessed value of the property. And the purpose of this is to make sure that properties in Canada are made available for people to rent or purchase so that they're actually occupied. Next slide. Okay, getting into some new information on trust filings. First thing I want to talk about is what is a trust? From a legal perspective, a trust is a relationship where a settlor contributes some sort of an asset to the trustees, and the trustees then have the responsibility of looking after what we call the trust property, or those assets, for the benefit of beneficiaries. So from a legal standpoint, it's a relationship between a settlor, a trustee, and a beneficiary. But for tax purposes, a trust is treated like an entity. And there are new trust filing rules that have come into effect as of December 31st, 2023. Under the old filing rules, there was no need to file a trust return if the total income of the trust was less than $500, and if not more than $100 was distributed to any single beneficiary, and the trust did not make any distributions of capital to a beneficiary, and it did not make any distributions to non-residents. So under the old rules, there were reasons that we could get around having to file if there was very limited activity. But these new rules have come into play as of December 31st, 2023, and virtually all trusts now must file a T3 trust tax return, even if there is little or no activity. This includes most trusts that existed at any time during 2023. Most trusts are deemed to have a December 31st year end. So as we talk about who might need to file now, keep in mind that the rules apply even if the trust didn't exist at the end of the year. It's still possible that it's something that would need to be done for 2023. Okay, so what are these new rules? Well, virtually all express trusts, which are trusts created intentionally by a settlor, that are resident in Canada, are required to file, and there is a new Schedule 15 that reports certain information about the participants in a trust, in addition to the usual income, expenses, and distributions that a trust needs to report. There are still exceptions for a trust that has no taxes payable and had no dispositions during the year, as long as it had been in existence less than 3 months, or it holds only money, arm's length loans, and certain marketable securities, noting that that does not include precious metal or GICs, where the fair market value of the assets held did not exceed $50,000 at any point during the year, or it is a graduated rate estate. There are other very specific exceptions for qualified disability trusts, registered accounts like your RSP or RIF, and some other very particular circumstances that tend to only apply to very certain trusts. So what does this include? Well, formal trusts, where a trust document exists, where there is a written trust document that indicates a settlor, a trustee, the beneficiaries, and the terms of the trust. But this also now applies to informal trusts, which are very commonly used at financial institutions for minors. Often we see these as an account with an ITF designation on it, which is in trust for, where there's no specific written document, but the account is tagged as in being in the hands of one individual on behalf of another. We see this a lot where parents open bank accounts or investment accounts for minor children who are not yet old enough to sign documents themselves. So these new trust filing rules apply to these informal trusts. And also where we think there may be a lot of exposure is something called bare trusts. Bare trusts are not defined in the Income Tax Act, but essentially a bare trust is where somebody is holding legal title on behalf of another individual or entity. This may be a very prevalent situation where people have done some estate planning and they've added children on title to their real estate or their non-registered investment account as a way to avoid probate, or if it's somebody just holding that interest on behalf of another. Next slide. So bare trusts exist where a person or corporation holds legal title but has no economic entitlement to the asset. And we've got a number of examples here. An individual adds a spouse or common law partner on title for ease of administration and estate planning purposes. I mentioned elderly parents adding a child on title. Parent is added on title to assist a child with obtaining a mortgage to buy a home. We see that fairly often. Parents setting up a bank or investment account for a minor child, or a corporation holding legal title of real estate on behalf of another corporation or individual. All of these examples are now caught under these new trust filing rules for 2023 and going forward, where they did not need to file in the past. As part of the new filing, there is a Schedule 15, which is new for 2023, and it requests information about various participants in the trust. It asks for information regarding the settlor, so the person who created the trust. It asks about trustees, beneficiaries, and protectors. Protectors is not something we see in Canada very often, but it includes anyone who can exert an influence over the trustees' decisions regarding any distributions of income or capital. So if we have any participants in a trust, we need to fill out a separate Schedule 15 for each person with their name, address, date of birth, their tax ID, which in Canada would be their social insurance number, and the tax jurisdiction in which they reside. This is all new information, and if any of these situations apply, we will need you to dig up this information on all of the participants. If we set up a family trust to hold shares of a private corporation, which is a fairly common tax planning step that we take, often we have that trust borrow money initially to be able to purchase the shares of that private corporation. So non-arm's length lenders to a trust also need to be listed as a settlor. In the past, We've had settlers and lenders to trusts essentially have a one-time involvement to get trusts set up. But going forward, these individuals will need to be reported as having had that involvement. This is true with trusts that have existed for many years, as well as anything new being set up. So it may be some homework for those who are trustees to dig up this information and be able to report on these new schedules. Some challenges with the new trust reporting rules. We need to know the date that the trust came into existence when we prepare a trust tax return. If we have a formal trust document, that may be easy to determine, but where we have perhaps someone being added on title to a joint investment account, let's say, there wouldn't necessarily be any specific record of when that happened. So there may be some digging of old records to do to come up with that answer. We need to then register for a trust number with CRA and give that trust a name, even if a trust hasn't been reported in the past. And the beneficiaries may not be clear due to a lack of documentation. I've got an example here. What if an individual has 3 children, but they add one of the 3 on title to their non-registered investment account to help them manage those funds? Is the beneficiary of that trust just that one individual? Is the account supposed to go to all 3 kids? There may not be documentation that tells us. So it'll be important to determine what the intention was when the individual added someone on title to the account and who exactly are the participants in that trust going forward. A formal trust may name a class of beneficiaries. Often we see family trusts being set up to include the issue of parents or the issue of children. Issue means lineal descendants of the next generation. So children or grandchildren, essentially. Where there is issue named as a class of beneficiaries, there may be some homework to do to find out exactly who those people are. So if a formal trust names a class of beneficiaries, we need to figure out what entities or individuals are in that class and be able to report on Schedule 15 the specific information. They may also be contingent beneficiaries. We see this where a trust has a common disaster clause, basically saying, well, if none of the named beneficiaries are alive and there still is money in the trust, then the trust property is distributed as per the terms of the will of the trustee. That's a common approach. So then we would have to look at what the will says to determine who are the contingent beneficiaries, also list them on Schedule 15 as well. For any trust returns, they are due 90 days from the trust's year end, which typically is December 31st, or the next business day. So with March 30th falling on a weekend, and it happens to be Easter weekend, the deadline for this year is pushed till Tuesday, April 2nd. So that's the filing deadline for any trusts that need to report. This year, there is an exception to the filing deadline for bear trusts. CRA will waive the normal late filing penalties, but only for this year. We think that CRA isn't quite sure what to expect on this front because this is a brand new requirement. And I don't think anyone knows exactly how many bear trusts exist in Canada. Think of all the situations where somebody has been added on title. We have a ton of those situations, and CRA is willing to waive the late filing penalties as people learn that they need to comply. The normal late filing penalties, 5% of the unpaid tax when the return was required to be filed, plus 1% per month for every month that the return is late, up to 12 months. So potentially 17% of the unpaid tax. The penalty goes up if there is repeated failures to file on time. And if there's no balance due, which is typical for these bear trusts, there is still a penalty of $25 a day with a minimum of $100, maximum up to $2,500 or 100 days worth of penalties. So for those who need to file, even if no tax is owed, it's still important to get them submitted. Next steps, confirm the legal title of the assets to determine if a trust filing is required for this year's. Consider any joint accounts if those accounts truly are held economically by the joint account holders, or if the joint account holder is just holding title of that account in trust for the original owner. Have settlers confirm their intentions in writing so we have records of what the situation is. Contact us if you have any questions or you believe you might have to file. We're happy to assist. With that, I'm going to pass it back to Barbara to finish up.
Okay, that's great. Thank you very much, Paul. We're just going to go through just a few more quick things, but please don't leave because Natalie is going to be picking some numbers out of a hat and handing out some prizes. So please do stay until the end. Just a few other things. Our online platform is set up and ready for you to upload your documents. Very secure. Our 2023 folders have been set up for you. Just a friendly reminder, PDFs are easier for us to work with. Sometimes pictures come up sideways or blurry. So if you could upload PDFs, that would be wonderful. And if they have a name on it, so we'll know what's in the document, it makes it easier for us to locate things and ensure they get placed in the right spot on your tax return. This is just a sample of what it looks like online right now. There's various folders. So if you have a bunch of medical receipts, you can put them in the folder number 8 or donations 9, tax slips, they're all listed here. And then of course, miscellaneous, if you don't know, just throw it in the miscellaneous folder and then we can deal with it then. But we do thank you for taking the time to upload. Sometimes if we get too many emails coming all over the, so many clients, we don't want to miss anything. So it is great if you can please upload it to your secure folder. It's all one spot. It's there for you. We sent out our personal tax checklist, the PDF and Excel fillable version. So it's a great tool for you to sift through. And please do complete it. It helps us notify us of any changes to you, whether it's dependents, addresses, etc. And just in general for our presentation today, do be prepared for CRA to ask a question. You might go, not having a review or audit for maybe 10 years in a row and then experience a very large in-depth one. So it's very important to keep all of your receipts. Again, you can go back to the retention slide to see that you need to keep 6 years prior to the most recent filing. Plan for 2024 and how you can further save taxes. We know the capital gains inclusion rates, and there was a lot of hype about that last year that they might increase it. They stayed the same. What's going to change when the federal and provincial budgets are released later this year? We don't know. If you do have shares in a private company and you haven't used your qualified small business corporation exemption on the sale of them, that limit is 1,016,000 this year. It increased from 971 in 2023. So that's quite substantial. So taxable capital gain of $1 million, or sorry, a capital gain of $1 million on QSBCs would be tax-free in 2024, if you qualified, of course. There's various conditions. Principal residence exemption, sure, it hasn't changed, but there's new property flipping rules we need to consider and be careful of. And yeah, be proactive with your tax and estate planning. We're here for you and here to support you and to answer any questions that you have. So thank you very, very much, everyone. It's 12:31. We do have the questions. So let's just see here. I'm going to just check. Okay, I see 2 new. No, I don't. Is it possible that there's no questions? I don't see. Is that possible? Well, I guess we were meant then to go over in speaking time because I don't have any messages here. Okay. I don't see anything. Okay. Okay. Well, I'm sure we'll all have questions as we start gathering our documents, preparing tax returns if we're tax preparers. But we're here for you anyways at any point in time to support you. And okay, we have a question here. Can 407 expenses be claimed as part of travel for rental properties. So assuming it's valid travel to your rental property, I would say yes, they could be. So the CRA would have to be able to see on your receipt that, let's say you live by the Bathurst entrance and your property is, I don't know, over at Highway 9, for example, and that might cost, let's say, $15 in 407 fees one way, another 15 back, times you had to visit the property 5 times a year, then yeah, that could be claimed for sure. Yeah. And John has a question. Okay, John, yeah. John, so do you want me to, okay, so you don't want to chat? Okay, you want me to, I'll let you ask it, John. Okay, I'm just asked you to unmute here. Let's see if we can do that.
Well, hi, Barbara.
Hi there.
I thank you, first of all, for a very informative session.
Oh, our pleasure.
So some of the questions, some of the issues related to the trust is very confusing. So one of the slides mentioned that when parents add name to a child or a spouse to an account, may also be considered a trust. How would that impact on, say, things like very simple things like joint accounts in a bank? Like, is that considered a trust and get caught in it as a result? I mean, that would be disastrous if joint accounts are so prevalent.
It's a very good question, and Paul, I'm sure Paul has the answer.
Yeah, absolutely. That is an issue where somebody had their own funds and a person is named as a joint account holder but wasn't a contributor. If the intention wasn't to gift half of that property to the individual who was added on title, then absolutely we do have a situation where a bare trust is in existence. So it could be spouses just naming each other as joint account holders for ease of administration and for estate planning purposes. It could be parents adding a child on title to an account. Absolutely, that is exactly what falls into the category of a bare trust, and this new trust reporting does apply in those situations.
So the follow-on is obviously from the bank's perspective, when you add a name or add your spouse to an account, they will always warn you, both people have full access to the account and be able to take money or do whatever transactions in the account. Would that be considered support for, so not just title only, but in fact that they have economic interest and they are essentially not a bare trust?
Well, having the ability to do something with the funds is not the same as having an economic interest in that account, right? So the legal title holders do have the ability to act on those assets, right? That's what comes with legal ownership. What it comes down to is what was the intention at the time that the person was added on title. Was there an intention to gift them half of the property at that moment? Or are they just simply being added for the benefit of someone else being able to help look after things and to have things pass automatically on death rather than going through an estate? So the existence of a joint account isn't determinative by itself. It's the intention of the individual who had the account first as to what did they intend when that account was set up. And I think in most cases, the intention when people add someone on title, it is exactly what falls into the category of bare trust, right? Having someone else help be able to look after things and having it passed to them automatically on death. So we have to look at the original intention at the time the joint account was created and whose assets were used. So if we have two spouses and they both have cash and they both put money into it, into a joint account, that doesn't create a trust necessarily. But if it's one, funds that belong to one of them and they just simply add the other on title, then very likely we do indeed have a bare trust and need to file a return.
Wow.
Paul,
Thank you.
That's great. Thank you, John, for asking. And Paul, I think this is so does a bare trust arise then on marriage if one spouse is on the title of the home? So sounds like one spouse is on title, then the other name is put on the title also. Is that a bare trust?
Likely, yes. So if the property belonged to one of the individuals and the other is added on title, then unless it was reported as a disposition of half of that asset at the time the person's added, then likely what we have is when the second person is added on title, they're holding that legal title in trust for the benefit of the original owner, and a bare trust likely does exist.
Okay, so as we can see, I think this is why the bear test, there won't be any penalties this year, only this year, everyone. But okay, I'm going to just go through one more question, and then I know we've got to respect everyone's time here. So apologize for being a little bit late. What happens with pre-construction properties? Let's say I bought a pre-construction condominium in 2020. It's finally ready. I take title in 2023 after construction. When does a 365 days? So let's say title was July 1st, 2023. That's when 365 days start. Yeah. Yeah. Okay. And so if you, and remember again, if we've all heard those shadow properties, flipping properties, like buying an interest like a condo and then selling it before it closes, so you never got on title, that, that's selling a right. And that for sure is definitely, you never lived in there. So definitely no principal residence exemption for that. And again, less than 365 days, it'll be taxed as business income, unless you have one of those other, you got divorced, disability, had a child, lost your job, became insolvent, went bankrupt, etc. So I'm going to let Natalie, and I've got a few questions here that I think we'll send the responses out afterwards. And I'm going to let Natalie just advise. Did you pull those names out already, Natalie?
Yep.
You have them
So
ready? Okay.
the first person is going to win a tote bag from us, and that person is Kathleen Johnson.
Oh,
Kathleen. Okay, and then the next one will be a t-shirt. Cool t-shirts we have here. And that person is George Young.
okay, that's great.
Okay, and the next person is gonna win the cool hat is Louis Spitaleri, Louis.
That's
And
great.
then we have our cooler bag here. And that person is Stephanie Yantis. Stephanie,
Oh,
congratulations to all. I will contact everyone and send them all off to you.
oh, that's great. Wonderful. And so again, and to respect your time, we thank you so much for joining us today. And you know where we're at. We care about you, your taxes, your wealth. We'll help you maximize it. And we're here for you. Thank you so much, everyone. Have a great day.